Traders in technical analysis spend all their time focusing on only two categories of indicators: new indicators to look for trends and good price moves up or down. Or the second category is indicators that help you find, on the contrary, bounces from charts when you are not looking for a trend, but a correction spot or trading on a bounce from the chart. But there is a third category of technical indicators that are given very little time. And, in my opinion, for nothing. These are indicators that are definitely worth paying attention to. These are volume indicators. Volume, there are quite a few. But my favorite indicator is the indicator that stands for average true range, the real range of the chart. What does the indicator show us? This indicator shows us how much the chart has averaged over the last 14 candles. That is, it shows us the most important thing we need to see in the market, which is the current volatility and the current trading volume. So, in my opinion, this becomes the perfect tool to add to any strategy. No matter how you trade, you can add either and generally improve your results. Let's talk about the key strategies, the key principles of using it. So, the indicator. This can be added if you go to the indicators menu and type in ATR in the search and add it to the chart. You can change its parameters. The main parameter is the period. It shows the average volatility over 14 candles right now, but you can tweak it to fit your strategy. If you use any strategies, you can set the period from 5 to 10 and see shorter volatility. Conversely, if you are trading some long signals, long-term trends, you care about volatility. For a longer period, you can exhibit a period of 20 or more, but the average but a pretty universal approach to different strategies. It should also be noted that the indicator depends on the time frame. That is, if we are now trading the 0100 frame, then every hour is 0100, which means we have the average volatility for 1400 shown. And if we change to another indicator, for example, for 1 minute, they will show volatility for 14 minutes. That is, it is important to remember that the indicator is matched to the one you are working for. So, the indicator itself looks like a curved line that rises and falls, but really the line itself is an ancillary point. The most important thing to look at is the value, what kind of value it shows. If you hover over it at any point, on a line, at any point on the chart, it will show you the number of points the chart has traveled over the specified period. So if we point specifically right here, we see that there is 703 points or 70 basis points of volatility here. Depends on your view, a point is a pretty high volatility. But it's also worth noting that it's going to be an indication, so you can't tell when they're high. When they're low, everything is relative. Because, for example, volatility, if you set the indicator, for example, on gold or, for example, on some bonds, it will be generally low. And even its high values will be low relative to, for example, Bitcoin. If you put up Bitcoin, it travels a much greater distance in the same amount of time. To see the full picture, head to the next video. The breakdown goes deeper there. And for him, the high and low figures will already be different. The best way, in my opinion, to find an approximate value is to simply zoom out of the chart, zoom in, that is its scale, and see what values would be considered low. Here we see 3 low points. If we hover over them, here it's 340 points, here it's 340 points, and here it's 290 at all. The period of low volatility was likely overnight. So, when we know that for this particular asset, in this case for Bitcoin, 300 to 350 points is low, it means that we now have a starting point. And now we can find those moments when we have low volatility. And when we have low volatility, it means that soon it will start to rise. As in this case, we had a period of low volatility, then it started to rise. First we had a period of low volatility, then volatility started to rise. What is important to us is that after periods of low volatility, when volatility starts to rise, there is trading volume in the market. And specifically during these periods of transition from low volatility to high volatility, the most important trends will appear on the market, biggest trends. And it is important for us to understand, to catch this moment, when the indicators will start to grow from the minimum value. And in that case, we only need to now look at which way it's rising in order to make a trade up or down. Another important caveat here is that the growth of this line does not mean that the chart will go up. We can find periods where we have, for example, like here, where volatility was low, then it went up, but at the same time, the chart is falling. Here too is a period of high volatility. but the graph is falling on its own. This shows that we have a lot of trading volume in the market, but it can be either down or up. Therefore, we do not look at the direction of the line itself. So, when we are at a point where it is close to its low values of 200 and 350, in this case we are further looking at which way the chart starts to go, and depending on that, we can make trades. For example, here's a trade, here's where the chart started to go up. We could have gotten a good buy trade. But as I said, volume indicators, they are mostly auxiliary and can be used with different strategies. So, let's add any indicator to the chart. Let's take the easy way out. Let's just add a moving average with a period of 200. This is a very simple and basic strategy for finding trends. When you put a 200 period moving chart on a chart, you see you have periods of long-term downtrend, long-term uptrend. When you have a 200 moving average chart, we trade up. When we have a chart under the moving average, we trade down. And now let's combine it with indicators. Again, I will reiterate that this is just an example. You can use any of your strategies to find trends, but this will show us the moments when we should pay attention to the chart and should think about opening trades. As you can see, we have a period of low volatility here. Next, volatility began to rise, and at the same moment we see the chart crossing our 200 moving average from bottom to top, which means this is a good moment to start a long-term rising trend. And this is where we could actually profit on a trend rise. Again, we see, low period. We're all waiting for it to start going up, start seeing volatility in the market. Here we see that the chart continues to rise and it is still above the 200 moving average. So we can once again open an up trade. And this downward crossover signal we would ignore because we realize that we have a growing volatility in general. Our chart is growing and it means that we need to make a deal upwards. And so you can combine volume indicators with any trend finding strategy. And so in this case we'll tell you whether or not the trend is really going to start or not. Because if you see a signal for the appearance of a trend and the volatility in the market still has not appeared, it means that it may be just some kind of movement. And the chart will soon move into a correction. And in fact, the strength of such a trend is not there. That is why I believe that volume indicators are worth mastering for any trader. And it is worth trying to combine it with your strategy to compare the results with and without ATR. And be sure to post your results.